Okay, well, I'm going to give a quick update on what's happening in corn and soybean markets. We've obviously had some interesting stuff that's occurred over the last couple of months. There's been a couple of real big differences that we've seen as far as movements in the corn and soybean market. I'm just going to quickly talk how the supply and demand picture looks for the upcoming marketing year and the rest of this marketing year. And then I'll talk about what to watch for as we progress through this growing season. So if you look at the latest USDA numbers, and again, we do have to be cognizant that these are estimates that they are working with. So 2016, 2017, the second column in this graph would be the current marketing year that will end at the end of August here. The projected one for 2017, 2018, the June numbers would be the one for the crop that's going to be harvested this fall. Now, one thing that we do have is we kind of have two, I guess, contradictory indicators that I've outlined here. One is positive for prices, the other one still remains negative for corn prices. As I'm sure most of you have seen, December corn prices right now are above $4. That's a pretty good price level given where we've been the last couple of years. I'll talk a little bit about prices and what we've seen the last couple of years a little bit later on. But right now we have kind of one thing that's really weighing on the market, and that's these large stocks, both domestically and internationally. You can see our beginning stocks for this coming marketing year are just almost 2.3 billion bushels. That is a lot of corn that is left over from past marketing years that the market will have to continue to absorb. If you look down at foreign stocks, they're still estimated at 5.5 billion bushels. Now, one thing that has been really positive is if you look at where the USDA is projecting at corn ending stocks, they're projecting almost a 1.2 billion bushel reduction. Now, where most of this is coming from, as you can see, is a reduction in domestic production. That's largely attributed to this 4.3 million acre decrease of harvested acreage for corn. So again, what's going to really depend on whether this production number comes down as much as the USDA is currently projecting is going to be this yield number, what they're using as a trend line yield for national average of 170.7 bushels, and then again what this harvested acreage number. But this yield number is going to be very important. If we get above trend line yield like we have in 2015, 2016, this number is going to end up shrinking. And what that's going to end up doing is it's going to increase those stock numbers where you're not going to end up getting potentially the benefit of reducing global stocks as much. So again, there are kind of two conflicting things right now. You have a definite reduction in U.S. production that will hopefully end up aiding in bringing prices up a little bit. But again, you still do have those large stocks, not just of corn, but of other grains as well, that we do have to still chew through. So again, when you think about the push and pull from a price perspective, there's a definite trading range that has been established because the market has factored in all this information. But it's important to understand that this trading range, you can use it to your advantage when you're doing your marketing. If you look a little bit more on the global side, what I've got is I've got big producers of corn highlighted in bold and black, and then those that are high use areas highlighted in red. So you can kind of see, I mean, obviously everybody hears about the South American crop, and there's a lot of information and attention paid to the progress of Brazil and Argentina, and rightfully so. They are substantial competitors, but really not as much for corn as they are for soybeans. If you look at U.S. production, we're estimated up around 14 billion bushels, Brazil at 3.7, Argentina at 1.5. Yes, they are important for global corn exports and for global corn stocks, but I mean they're roughly combined a third of what we're what we're producing in the U.S. So again, the progress of the corn crop, across the U.S. is going to be a very important component as to how close the USDA numbers as far as this beginning stock number and then this ending stock number are going to be for the world. And that's really what's going to end up dictating price direction as we move through this growing season. So far, growing conditions have been reasonably good. There's been some challenges with getting the crop planted, and there are some weather concerns. But at this time, we're kind of at that average progress. So again, there's nothing too alarming on the horizon, but the production in the U.S. is what's really going to drive this market as we move through this growing season. If you look at price action, again, I mentioned that there was that we were over $4. You can see this is the last 6 months for the December 2017 corn contract, and I mentioned we've traded in a real tight trading range. So you can see the low back in the end of December for the 6-month period was right around 375, but we really haven't got much over that 415 range. So it's been a really tight 35-cent trading range, which again gives you kind of an idea what the market has factored in right now. You can take a look and say, well, if it gets above $4, maybe that's a time when you want to end up doing a little bit more incremental pricing. So pricing maybe another 1,000 or maybe another 5,000 bushels as we go up, say a nickel or a dime on the futures market contract. The one thing that I think we have to be cautious with is having unrealistic price expectations, right? To think that corn is going to make it up to $5, yes, it's possible. Is it likely? In my opinion, it's not very likely that we would get that high. Now, if we look at what's happened the last 3 years, the blue line on this graph is where we've been in 2017. The red line is the 2016 December contract for corn, and the green line is 2015 December contract for corn. So again, within these 3 years, we have had opportunities to price corn above 4 1/4. Now, one thing that is abundantly evident from this graph is that those intervals to end up pricing corn at that level have been very shortly lived. And part of it's because there was a weather scare or planting scare that kind of allowed the market to run up the price a little bit, and then when it did not fully materialize, prices came back to regular levels. So again, it's not to say that if there was a drought or there was a production issue that did end up occurring, we could see prices go up on an upward trajectory and then kind of flatten out. But again, what I think is more likely, given where we're at right now, is that we're going to continue to see this sideways trade as we move through the year, unless we see something that really does provide evidence that there has been either a reduction in yield from the trend line or a reduction in production in the U.S. So again, what I think we'll see is we'll see this kind of trading channel of roughly between 420 and down to about 380, and we'll continue to push sideways. Now, anytime you're seeing futures prices that are bumping up above $4, like I said, I think that's a pretty good time to secure a price, whether it's through hedging some additional production or whether you're looking at a cash contract. In corn, I don't think it's as imperative to get a downside or putting a put option underneath it or a minimum price. I think we're reasonably set on the downside given how much acreage we've dropped in some of the production. I think really what's unknown now is if we do get a bit of a weather scare, is there some upside? So again, we will still have those seasonal influences as we move through the production year. So I mean, waiting to sell everything at harvest, you're probably still going to end up getting a lower cash price. But if you can secure some price protection when futures are near $4, I think it's very, very prudent at this time. So again, it's kind of a good news, bad news with corn markets right now. Domestic and global stocks are projected to decrease for the upcoming marketing year. It's largely driven by a reduction in domestic production. The bad news is that we still have very large corn stocks and grain in particular. I'm not talking about wheat today, but wheat stocks are record large. Obviously, corn and wheat can be used as substitutes for certain uses, particularly on the feed side. So we do have to be cognizant that even though we are going to have potentially a reduction in corn, it is going to also be contingent on what happens with wheat and sorghum and barley and some of these other quasi substitutes. The other one that is kind of a bit of a concern right now is exports are currently being projected down. Part of that is due to currency issues. Again, the US dollar is still reasonably strong. We have seen it kind of pull back a little bit, which helps, but there's always seems to be some type of issue down in South America that's going to make it so that one of those currencies has a bit of a leg up on the export side of things. So as far as price direction, again, I've got about $1 range here on the December futures contract, but I really believe that we're going to kind of move sideways between that 350 and 450 range unless we do see some weather issue form within the U.S. And more likely, I think we'll kind of see between that 420 and that 390 or 380 range. I think it'll be a little bit tighter range as we move across on the futures side. Again, I think there's going to be some opportunities in Tennessee on the basis. So again, depending on where you are within the state, I think there can be some opportunities there to get some good beneficial basis increases. Particularly down in southern middle Tennessee, I think there could be some opportunities there to get some good prices as long as production continues to cooperate. If you look at soybeans is kind of the opposite of corn on the production side. We've seen that 4 million acre drop in corn harvested area or projected corn harvest area. Well, that plus a little bit more is projected to go into soybeans. The June acreage report is going to be real interesting because obviously these June projections are based on that March planting intentions report. So again, when we see these acreage numbers, this will kind of give us a better idea of how weather influenced planting decisions as we look across the U.S. So it'll be interesting to see if we're close to this 88.6 million acres harvested or the 89.5 million acres planted, I guess would be more specific. But if we are a little bit above this or a little bit below that, that could end up moving the needle a little bit. One thing that has been, I guess, kind of a real struggle from a projection standpoint the past few years has been the USDA's inability to really accurately predict where ending stocks were going to be for the past three marketing years. They seem to have always been high. They started, somewhere up around that 400 million bushel carryover, and then it continued to whittle down for that marketing year. And what we've seen these ending stocks or the next year's beginning stocks come down under 200 million bushels. Well, one thing that we've seen for this current marketing year is that stock number has not come down as much as some have in the past. So when you're looking at a projected beginning stocks of 450 million bushels, that's a little bit different circumstances than when we were looking at having a 200 million bushel carryover. So, that's definitely a negative for prices. Total supply, again, with your increased production, increased carryover, you're going to see about a 200 million bushel increase in total supply. On the positive side, crush has been very good. We've seen continued growth year over year. So we're almost crushing 2 billion bushels. Exports, again, been fantastically strong. The only thing that really concerns me about exports is China. Obviously, they're the primary importer of soybeans, both from us and from South America. But they can have policies or put up trade restrictions that could, dramatically influence prices. If you have most of your market is reliant on one producer, that can be a little concerning from a risk standpoint. So if you look at this again, I've highlighted in black the the key producers, and then in red the key users of soybeans. Well, if you look at soybeans, I mean, the EU is next on imports with about 550 million bushels, but China, I mean, 3.4 billion bushels. I don't see them making any dramatic changes to their policy. I mean, they do need the soybeans to end up feeding their livestock. So I don't see that changing. They don't have the capacity to be able to produce anywhere near enough of that, or anywhere near enough soybeans to end up supporting their livestock industry. So I don't see that changing. I think it will remain reasonably consistent, but it is concerning. I mean, having one country responsible for that much of a global market is a high risk. You look at November soybeans. Again, this is very different than corn. We've seen a continued decrease. I sure hope that that producers took advantage of the pricing opportunities we had back in early winter here in January, February, and March, when we had prices up over $10. Obviously, since then we've seen them come down. They set a bottom, or a 6-month bottom back in late May at just over $9, and we've seen it come back up. Again, depending on where these June acreage numbers, there could be another leg down in soybeans. I mentioned corn is probably more likely to trade a little bit flatter sideways in a trading channel. Soybeans, I don't necessarily think we've hit the bottom of this market. I think we will continue to move down, particularly if we get confirmation that soybean acreage is up from where USDA estimates were. So again, if you look at the past 3 years, kind of take a look at what soybean markets have done. Again, we've seen a big run up. Last year got up over $11. I don't see anything like that coming to fruition this year. I think it'll be a challenge even to get back near the $10. What I think we'll see for the November contract is it kind of continue to slide down and probably end up coming close to where we were in 2015, where we actually get below $9 on the futures contract. Again, a weather anomaly could end up influencing that, but I think that given the amount of acreage, if we get close to a trend line yield, or if we get better than trend line, we'll see that continue to erode over time. So again, one thing that I think is a very key difference between corn and soybeans is I still like getting a floor under those soybeans more than corn. I'm always a proponent from a risk management standpoint of getting a floor underneath your commodities, but at the same time, I think in soybeans it's more prudent at this point than corn, or more important, I should say, to do it corn. So again, soybeans is still a good news, bad news. There's still strong domestic and global demand, primarily driven by Chinese influence. The bad news, we have seen an incredible increase in global production. Obviously, it's been well documented, Brazil's record soybean harvest of this past year. So again, it'll be interesting to see when they start doing their main season beans in the fall here, what type of acreage numbers we're looking at. Obviously, a lot of that's going to be price driven, but we are a highly concentrated market on the production side. There's the U.S., Argentina, and Brazil, and so those three countries is really what's going to drive the supply side. Reliance on the Chinese market, there's some unpredictability there that you do need to be cognizant of. Like I said, it's not a huge issue right now, but again, that's the nature of unpredictability. You don't really know for sure what is going to end up happening. As far as price direction for the remainder of this production season, I see us going probably on the lower end of this range, and like I said, from the 940, 950 where we're at right now, I think we'll see continue erosion of the futures price. How close we get to this 850 or below 850 will be driven by where we see those trend line yields and the final acreage numbers as well, which will be revealed by the USDA in June. So again, those are going to be important to take a look at. So what to watch for as we progress through the growing season. Obviously, weather. I'm not going to spend a lot of time on it. I mean, you can read the same weather reports as what I do. Right now, yes, there has been some challenges as far as getting the crop planted, but overall, the crop is in reasonable shape. Exchange rates, I'm going to touch briefly on that. The one that really I think is still a wild card, and I'm leaning towards this probably isn't going to affect in-season production is potentially winter marketings, but global trade, I think, is going to rear its head at some point. Exactly what occurs from that, I think, is very unknown at this point. It could be very good for agriculture, but it could also throw up some significant roadblocks as well. Drought monitor, you can see, most of the Corn Belt, we're in pretty good shape from a moisture standpoint. I would argue that probably there's places that have a little too much, it would be a hindrance to production. Exchange rates, the one thing, and this is usually kind of glossed over, but I really want to emphasize, I mean, when these exchange rates move, it moves the sourcing of particularly soybeans, but ag products in general. So if you see the Brazilian real weakening, you see quite a bit of export business that will potentially shift from the U.S. to Brazil. A weaker currency makes it easier for countries to purchase goods that are produced in that country. Now, the opposite is true for imports. If you have imports such as fertilizer or machinery, they are very expensive if you have a weak currency such as in Brazil for them to source. So that can end up being a production impediment down the road. One thing, I pulled this quote from an article I was reading last time. This kind of highlights why exchange rates are important. This is specific to JBS, and I got talking with a guy from the Rosario Grain Exchange a while ago up in Washington, and he said most of his customers are more concerned about the exchange rate between the Brazilian real and the U.S. dollar than they are with the change in soybean price. That's how dramatically it impacts their business down there. The exchange rate really does matter. Anyhow, what this article ends up indicating is JBS, they have a derivative, so basically their work to end up mitigate exchange rate risk for JBS. Well, their exchange rate desk is scheduled to make $3.65 billion, so more than what their beef, poultry, and pork operations are scheduled to make combined. That's how important exchange rates are for a lot of these operations. China, again, it's headlines like this that kind of always worry me a little bit. China may clamp down on soybean imports as traders are discussing the possibility of tighter restrictions on imported soybeans for food use. China allows GMO imports for domestic crushing, with the soy meal going towards livestock feed. They do not officially allow imported soybeans to be used for food use. Now, I know everybody is very well aware of what China says officially versus unofficially. It can be two different things. But what really highlights on this is, I mean, if they really wanted to use something as a potential trade barrier, this could be the card that they would attempt to play. So again, you never really know. That's why I put question marks beside it, because you never really know what China's going to end up doing. But it is something that's very important to the soybean market. Last one was trade. NAFTA renegotiations. Mexico is the #1 buyer of corn. Canada and Mexico are also important purchasers of soybean meal. How those trade negotiations progress are going to be very important for soybeans. Also, since the U.S. is no longer going to participate in some of these large trade deals, there's going to be a lot of bilateral negotiations. So in between an individual country and the U.S., how those come out, I think, again, aren't going to necessarily affect this production season, but it could really have some implications as we're marketing our crop this winter. We'll have to see. But again, right now, there's such a paralysis in the federal government that until that's worked out, I don't think anybody's really going to want to bite off another big chunk as far as picking a trade battle. Prices, again, what I would do is I would look at working incrementally to achieve a price. So again, sell in 1,000 or 5,000 bushel increments as prices rally. Adjust or adjust your pricing, increase your pricing as you see where your yields are going to end up moving through the growing season. If you think that you've removed some of that production risk, you might want to look at securing a price on another 1,000 or 5,000 bushels, and then just make sure you track that net average price received. Because what that'll allow you to do is to work back up here to, well, am I above my break even, and what is that targeted price that I'm working through? If you can get somewhere in between that break even and that desired price, I think you're probably setting yourself up for a successful year from a marketing standpoint. So with that, that's all I've got for today. Again, there's some additional resources I do want people to be aware of. We post these marketing meetings up on our website, but we also post copies of the presentations. And then me and Andrew also do a weekly column that kind of just gives a quick update of what's going on in the market. So you can definitely get that from our website, or sign up and get it directly to your email.